Hello, everybody. Thank you for tuning in this week. Hope everybody's doing well and is healthy and safe and still staying relatively sane. I know we're trying. It can be a little trying at times with three wild kids running around, but I think actually we're managing pretty well and starting to think through what this new phase coming up, the yellow phase for our county and the surroundings mean, and starting to talk to the Steinwell staff about what that looks like for the office. And once we have a more clear picture of exactly the details of that, we'll make sure we let everybody know. We'll send out emails. We'll update the website. But likely we'll have the office somewhat open and somewhat staffed as well, starting when the green or when the yellow phase comes in. Although we'll of course be complying with as much as we can with the CDC guidelines and limiting people in the office. But at least looks like a step in the right direction in terms of the opening for this area. Although that continues to be an ongoing debate nationwide, and looks like some counties, LA County is staying on lockdown for a considerable longer time. Although other states are doing the exact opposite and are going more towards a full-fledged opening. So we'll be talking a little bit about what I think are some of the impacts of a lot of this new news and data today. And have just a couple kind of key things, what's transpired over the last week and even this morning to discuss. So why don't we just kind of jump right in and talk about some of the stuff that's going on. So for last week, stocks actually made a positive move to start off the month. S&P was up just over 3.5% last week, which is really the first positive move since around mid-April. And this is despite stocks were up, despite the fact that the jobs reports have still been pretty dismal. Job losses in April totaled 20.5 million to bring the unemployment rate back to a level that we really haven't seen since the Great Depression. Dow Jones was up just a little bit less, about 2.67% last week. Mid caps and small caps and smaller sized companies in general have kind of been leading the rally, with small caps up 4%. Russell 2000 up over 5% last week. Year to date, I'm going to bring up a little chart because this is going to kind of be one of the themes that we're going to talk about today. So let me just grab this up here. So year to date now, for those who are looking on the computer, and this is as of today, so this does include the tick down that we saw this morning after Chairman Powell had spoken. So the S&P is right about negative 12% year to date. Dow is still down about negative 17.5%. And then I think to much surprise, the NASDAQ is actually flat and has actually gone even positive for the year at various times over the last couple of days. And we'll talk a little bit about that. So just to kind of look at what that means from the highs. So kind of that's the year-to-date numbers, but where is it from peak to trough? Dow's still down about 20% from its all-time high, which is right there, smack dab at the bear market run, but certainly a considerable amount higher than its low, which I think was almost negative 40%. S&P down about 15% off its high, and the Nasdaq down about 8% off its high. Although, like we said, it just kind of hit that break-even point for year to date. So somewhat surprising, I think, to a lot of people based off of those jobs numbers, unemployment numbers. For perspective, during the 113-month streak of jobs created from 2010 to February 2020, so pretty much right before all this happened, we added about 22 million jobs, and now we've taken away essentially all of those, which is quite staggering. The yield on the 10-year U.S. Treasury rose following those job reports last week. Although the job reports was slightly better than expected, it still was pretty significant. Let's talk a little bit about the equities again. So in that period of time, the small caps and mid caps have kind of continued to run this rally. This week we have less earnings reports. Most of the earnings are already done. So I think the market has pretty much priced in most, if not all, of what kind of this Q1 earnings are going to look like. And the big question has been, how has the market even come back from where it has? And we've gotten some of those questions from clients and just other people in general. And yeah, it's still considerably down from the start, from year to date. But I think a lot of people are starting to question how it's even come back to where it has, given the fact that we've lost 20 plus million jobs and unemployment is at around almost 15%. It could even get as high as 20%. So kind of what's going on here? And I thought it'd be interesting to kind of talk a little bit about that. So a couple of weeks ago, we had on our call one of our partners that we use a lot for economic data and research, First Trust. And we were talking with them last week about kind of their thoughts and their perspective. And I'll kind of summarize some of what our discussions were. So if we rewind the clock back to 2018, First Trust had, at the end of the year, set a price target that the S&P would hit 3,100 by the end of 2019. Right around that time, the S&P was at 2,500, and we did break through that 3,100, and S&P continued to soar. S&P rose almost 30% in 2019. And one thing that First Trust has always done a good job at is giving pretty close to solid information about their predictions about certain resistance levels. And so we really try to put a lot of thought into some of their information, because for the last several, really going back to the 2001 tech bubble and certainly the Great Recession in 2008, they've been pretty on par. They actually raised their 2020 originally, before pre-COVID. They raised their 2020 outlook for the S&P to continue to rise to about the 3650 level, and then of course the COVID-19 came, and that obviously changed everything. So pretty much before this pandemic, everybody was very bullish. And in fact, even today on the news, Chairman Powell had talked about the fact that pre-COVID-19, everything really looked pretty good in the economy, and they felt very solid about where the economy was moving. So did most economists. And then of course we kind of got wrapped up into this pandemic, and everything changed. So they've actually, to make a long story short, they've adjusted their end of year, this is First Trust, their end of year 2020 target to about 3,100 on the S&P. And just to put that into perspective, where we stand today, the S&P is at about 2,860. So that's higher than it is right now. And I think a lot of people will be surprised to hear that. And they put the Dow at about 25,750. The Dow right now is at about 23,600. So they are expecting it to be about 6% higher than Friday's close. So they still see some growth opportunity in the markets. I don't necessarily think anybody's calling for a V shape at this point. Even Powell had kind of alluded to that in his comments this morning, where he had kind of spoken very specifically about how he thinks that it's going to be more of a longer trend to the recovery. He said, quote, "The recovery may take some time to gather momentum." So, I think that's reasonable to expect. But still, people are questioning, how is it even progressing this quickly? And I think really the range of the outcomes for 2020 are hard to predict because of how this virus is so unique. But we're getting, and the economists are, and the Fed are getting more and more information every day. And I think those key variables are really starting to come into play and being understood more. And most of those key variables are around how quickly the economy opens, the development of therapies and vaccines to fight the disease, and how quickly people are willing to go back to normal. And I we've talked about this in other meetings that just because something opens doesn't necessarily mean people are going to participate, although flights are ticking up and transportation's ticking up. And also, just because jobs are open doesn't mean people are going to come off unemployment. But those are certainly some of the key variables. It's kind of interesting because with the economy in such turmoil, people are saying, how have we bounced back this quickly from March lows? And I think one key piece to understanding this is that investors don't buy GDP, and oftentimes we look at recessions as measures of GDP, and people oftentimes confuse the stock market with the economy, and many times they are very heavily correlated. But they're not always, and in particular, towards the back end of a recession, they tend to not necessarily correlate as much because the stock market tends to pick up before the recession ends. But you're not buying shares of GDP. You're buying shares of companies. And ironically, a lot of those companies are actually still doing very well, even despite this economic carnage. One of the analogies that I've heard is if you imagine a company that has lots of competitors around them, and then one day out of the blue, a meteor just shoots out of nowhere and destroys and decimates their competitors, what's going to happen to the one company that survives? Well, of course, nobody's going to celebrate the catastrophe of the other businesses that got destroyed. But that being said, that one competitor now has a major advantage, and as long as they're able to kind of figure out how to take that opportunity, they're going to do well. And we've seen that, and we've seen that right now, and especially in the larger, well-capitalized companies, in particular technology, and that's why, in particular, we've seen the NASDAQ overperform the Dow and the S&P and really kind of gone back to pre-COVID levels because a lot of those companies have done well. Some of the big box chains that have been permitted to stay open also have been very profitable. And they've certainly, well-capitalized tech companies and big box companies have certainly had a competitive advantage over what they call Main Street competitors, which is kind of more like small businesses. And those are the companies, the bigger companies that are listed on the exchanges. So, when you kind of think of it that way, it kind of makes a little bit more sense. Unfortunately, this COVID-19 pandemic has really been a small business recession. And if you start to look at some of the numbers, if you look at the unemployment rates and where they're coming from, almost 40% are coming from the leisure and hospitality industry. So your restaurants and hotels, that's a huge number, and about 17% are coming from the retail side. So, 39 and 17% are from industries that, quite frankly, are lower paying industries. And not that that's a good thing. Of course, it's certainly a bad thing, but it doesn't necessarily have the economic impact, or maybe I should say the stock market impact, that maybe one would have expected seeing such a high unemployment number. In fact, the Fed report just came out this morning, and Powell had alluded to it in his comments this morning that 40% of the job losses, 40%, there's been a 40% loss of jobs in households with less than $40,000 a year. So that makes sense considering that such a huge amount of the job losses have come from lower wage industries. But that hasn't necessarily translated into the massive sell-off in equities that we saw in March continuing. Meanwhile, the capitalized profit models for equities based off of various things like interest rates suggest those somewhat higher levels than what we see today, and with the S&P at about 3,100, and they're actually saying that they don't even feel that that's overvalued. That just to kind of put that into context, a 3,100 S&P level assumes profits fall by 60% in their model, and they only forecast profits fall about 25%. So I think they're basically saying they even see some wiggle room where if that does happen, that the S&P will possibly even be undervalued at that point. And then they see a 2021 valuation of 3650 for the S&P. So, one reason to be bullish on equities is these days this quantitative easing that the Fed has done and continues to do goes straight into the money supply and not into excess reserves. And, that's one thing that we saw in 2008 happen was a lot of the QE money just kind of got sucked into reserves. And this time it's really kind of trickling down much quicker than in the past. And it's actually really been the fastest trickle down with the quantitative easing that we've ever seen. Meanwhile, the federal government is continuing to consider ramping up deficit spending. Powell even talked about that again this morning. And as unemployment continues to rise, they're doing virtually everything they can to try to offset that private sector loss of income and continue to keep those small businesses afloat, because really that's primarily where the damage is being done. And of course that does have fallout, and Powell did talk about that today. It's one of the main reasons why he's necessarily not as eager to say a V market, because there are consequences to having such a troublesome small business market with lower wage people. It just doesn't necessarily translate as easily to stock market depreciation, whereas it does more kind of longer drawn out issues. But at least that kind of gives the Fed the opportunity to try to continue to provide stimulus to kind of chip their way out of that over a reasonable period of time. Regardless of what we think about these policies, because there's a lot of pros and there's a lot of cons, I think, kind of to make a long story short, a lot of economists are still supporting equities moving forward, despite the fact that we're kind of really still struggling as a country to kind of figure out what direction we want to go in terms of opening up or not opening up. And of course, probably the best solution to that is not have one blanket solution, and areas that need to continue to stay closed may have to, and others that are less risky will likely continue to open up. But I think at least this kind of maybe helps put into perspective a little bit of understanding about why we've very much seen a detach between kind of what's happened in the stock market over the last few weeks and what's continued to happen with job numbers, unemployment numbers, and just kind of the economy in general. And it's kind of interesting, at least to kind of think through, really where are those things coming from. And I think had you asked anybody, would they expect at least the NASDAQ to be positive at this point? Pretty much everybody would say no. But companies like Amazon and Facebook and Netflix are maintaining really strong revenues, because that's where people are spending their money right now. And obviously the alternative like airlines are struggling. And yeah, airlines are bigger companies, and certainly that plays an impact on the markets, and likely why there's such a huge disproportion between the S&P right now and the NASDAQ, and even the Dow. But really that massive difference falls more on that small business market, which isn't necessarily represented in the stock market. Certainly it is in the overall economy, but not necessarily in the stock market. So I just thought that would kind of be an interesting topic for today. It was kind of interesting to see Powell come out and talk a little bit about his thoughts on things. One key takeaway from that, which we already mentioned, was probably more of a U rather than a V. I don't think that's surprising to anybody. But the second part was there doesn't seem to be any indication that the Fed is not still 100% focused on stimulus. And again, like I mentioned before, we could debate for a long time the pros and cons of the continued stimulus. And Congress has, a really tough job to figure out how to make those programs as efficient as possible. But between what Congress is doing on their side and the Fed on their side, they're pretty much committed to spending their way out of this pandemic. And it doesn't look like, at least from current information, that's going to stop. So, lots to kind of think through what that means long term, and we've spoken about that on other calls in the past, and we'll kind of continue to discuss that in future calls and over the course of time. But that's where we are today, and they're just going to continue to spend to try to support everybody that they can while we see this virus kind of come to fruition, hopefully. CPI index was just released. I don't think it was too far off from what everybody expected. There isn't any inflation right now. In fact, it declined about 0.8%, which pretty much matched the expectations, primarily driven by low energy, low food, low travel. So a lot of the kind of industries that have slowed down, we've seen some prices come down, and that certainly has a major impact on why we saw that CPI number come down for April. So I think that it'll be interesting to see what that looks like long term, but at least for now, there really hasn't been much of a move anywhere from an inflationary perspective. Although it'll be interesting to see how that gets impacted in the future. So I think that's primarily everything I wanted to touch on today, and hopefully this helped kind of give a little bit of perspective into kind of where some of the economists see 2020 shaking out, and perhaps gives a little bit more of an understanding as to kind of what's transpired and maybe actually more why things have transpired the way we've seen them in the markets, having somewhat of a unexpected recovery over the last couple of weeks. So I'll turn off mute real quick and see if anybody has any questions. Any questions out there? All right. We have a speaker on next week's call that is going to be discussing some estate planning. So we will be sending out information to everybody about that, and hopefully anybody who would like to join us for that call can make arrangements. So we will be getting that out shortly. This will, of course, be on replay. For those of you who have not heard it, you can certainly jump on and listen to it on our website, as well as all the other prior calls that we've had. So if you've missed a call in the past and you'd like to jump on and hear what we've been talking about, you can do that by going to the COVID-19 resources section on our website, and you'll find links to virtually all of these on there. So thank you, everybody, for your time. We really appreciate you joining us, and hopefully you find these valuable. We'll continue to do these for the foreseeable future. And if there's anything we can do for anybody in the meantime, please don't hesitate to reach out, and hope everybody stays well and safe. Thank you very much.